Okay, so before we get started on the lecture material for Chapter 5, I want to take a look at the 1040 for a minute, okay? So, this Chapter 4 and Chapter 5 are all about income, okay? What is and is not income. So if you look here, line 7 through line 22 of a 1040 are all about what is income, okay? Now in Chapter 5, the focus is on exclusions, so things that are excluded from income. For the most part, things that are excluded from income do not show up at all on a 1040, okay? There's no line for exclusions on a 1040. There are some things that we will talk about in Chapter 5. There are a couple exceptions to that rule, that although they are excluded, they are reported on a 1040. The first one I'll draw your attention to is 8B, tax-exempt interest. We are going to talk about that not today, but on Monday. So note, even though you do not have to pay taxes on some forms of interest, you still have to include it on your 1040. Another example, pensions and annuities. We talked about annuities last time. Even though part of an annuity payment is not taxable, right, because it's considered to be a piece of return of capital, you do have to include all of it on your 1040, but only the taxable amount is what you pay taxes on, which is what goes to 16B, okay? And if you'll notice, your adjusted gross income is down here at line 37, adjusted gross income, and it includes all the totals of this column, which are your income columns, minus your deductions, okay? So, some other things that are included in income. Wages, salaries, line 7, so this is your W-2 income. Qualified dividends, we talked about that last time. Ordinary dividends. Alimony received, we talked about that last week. Capital gain and losses, we've talked about that in Chapter 3 when we talked about the netting rules. Ooh, income from a partnership or an S-corp, line 17, we talked about that in the last chapter. Unemployment compensation, right here, line 19. Social Security benefits, we also talked about that. Here's the taxable piece right here. So as you can see, a lot of the things that we have been talking about, this is where they will show up on your 1040. And you do have some tax-exempt interest in your 1040 assignment, which I know a lot of you have not even looked at yet, but there is some tax-exempt interest that you need to make sure you look out for in that assignment. Okay, so that's it for the 1040 for right now. We will come back, of course, this time throughout the semester. Now I want to start on Chapter 5. Chapter 5 is all about exclusions from gross income. So let's first talk about some big picture facts, which we do look at in this chapter. We have Paul, he's a graduate accounting student, and he was an intern at a CPA firm the last summer. At the end of the summer, the firm was so pleased with the work that he'd done that they gave him an extra $1,500 more than they had initially agreed to pay him. He was also offered a full-time job after he graduated. He received a graduate assistantship that waived his tuition of $6,000 and paid him $400 a month to teach a principal's course during the semester. He used that $400 a month for books and room and board. Okay? In November, Paul was unfortunately hit by a drunk driver in a delivery van. He suffered severe injury to his right arm. These are the damages that Paul was paid. This is what the insurance company paid, okay, from the lawsuit. Okay, these are the damages. In addition, Paul's mother witnessed the accident and she suffered emotional distress. So she received $25,000 from the settlement. So, exclusions, as I just mentioned, are things not included in gross income. They are all found in sections 101 to 150 in the code. The first thing that is excluded, the first topic, which we have talked about already a couple times in the semester, is gifts. Okay? Gifts are excluded from income of the recipient. Okay? Now, of course, the donor may have to pay gift taxes. But we are not talking about gift taxes right now. We're talking about income taxes. And the recipient of a gift does not have to pay income taxes for that gift. Okay? Now, it has to actually be a gift. What does that mean? Okay? It must be voluntary. There must be what we call donative intent. If the gift is required to be made, if it's compulsory, it's not a gift. It has to be made out of the goodness of your heart. You are not required by contract or required by law to make the payment. If you are, it is not a gift. Okay? Secondly, it has to be made without consideration. A lot of you have taken B-Law, so you know about consideration. Some of you have not. Consideration is basically anything that the recipient is giving up or paying for the gift. It does not have to be money or property. Okay? For an example, let's say we have a father who tells his son, I will give you $300 if you quit smoking. That's not a gift, because the son has to quit smoking to get it. Okay? So that wouldn't be what we consider to be a gift. It's really a form of consideration. Okay? Also, past acts are a form of consideration. So, for example, there is a case called Commissioner versus Duberstein. This is in the book on page 5.3. This is a Supreme Court case. In this case, we had Duberstein, who supplied a businessman with the names of potential customers, okay, with no expectation of compensation. And then the businessman gave him a Cadillac, gifted him a Cadillac. The Supreme Court said, we don't care that you call it a gift. This is not a gift, okay? Yes, he did not, it was a voluntary gift. It was voluntarily made. But there really was consideration. This guy gave him Duberstein gave him business contacts of potential customers. He didn't have to do that, but he did. And that's considered consideration. It doesn't matter that the consideration was made before the gift. It doesn't matter. The Supreme Court said that is not a gift, even though the parties call it such. Okay? And kind of along the voluntary lines, there can be no obligation to make the payment. If there is an obligation, it's not voluntary. And there's a case that's listed in my notes, Robertson versus U.S. In this case, a prize was going to be given, a cash award, for the best musical composition. This was found to not be a gift because there was a contractual obligation to make the payment, okay, to whoever won the contest. Right? So that's not a gift. So just be careful. Just because the parties call it a gift does not mean that the IRS would agree. Okay? You may have to ask some additional questions. Similar to this line, inheritances, which remember are basically gifts made after someone dies. Okay? They are also not taxable to the recipient. Okay. If you have a transfer made by an employer to an employee, that is not a gift. Okay? The IRS has said that cannot be a gift because there is always some form of consideration when you're talking about a relationship between an employer and an employee. There's one exception to this, and we have talked about this before. This is an Employee Achievement Award, okay? This is if you give an employee some sort of tangible benefit. It can't be more than $400. It has to be for safety or length of service, something like that, okay? That's okay. But that's really an exception that's created under a different provision of the code. Okay. This is another little exception that they include. If you're a victim of a qualified disaster and you're reimbursed by your employer for certain expenses, then that can be excluded. Okay. Pretty minor exception, but it is there. That was on slide 8. Okay. Along the same line, employee death benefits. If you have an employee that dies and the employer makes some payment to the spouse or the child, okay, these amounts can be excluded from income, but there are some limitations involved, okay? They can't be required to make it. I'm trying to see where it talks about this. Oh, this is on page 5.4. If you look, there are 5 bullets, okay? All these things have to be met for these payments to be excludable from the gross income of the spouse or the child that receives it. Okay, it has to be made to the spouse and the children rather than the estate. The employer has to get no benefit from it. The spouse and the children cannot perform any services. The person who died had already been fully compensated for their services, etc. Okay? Again, a very minor exception to that, but is there. Oh, they're right here in the slides. Sorry, forgot about that. So, to our big picture facts. Paul received $1,500 extra compensation for the services that he provided. This was not something they were required to do. Is that a gift? No, it is not. It's just compensation, just like a bonus. Okay, it's not a gift. Okay, the next item that is exempt, life insurance proceeds. This is on slide 12. So the general rule with life insurance proceeds is that the proceeds are exempt from income. Okay, maybe that's a gender. So when father has a life insurance policy with his daughter as the beneficiary, and father dies, and the proceeds are paid to the daughter does not have to pay income taxes on the proceeds of that policy. Life insurance policies are a really commonly used estate planning tool because it's a great way to get out of paying income taxes on something, but it's also a great way to get out of paying estate taxes. If you are subject to estate taxes, there are certain types of life insurance policies you can get that are excluded from estate taxes. Okay? So people that practice estate planning use life insurance policies often as a way to avoid both estate taxes and income taxes. Okay? There, of course, are exceptions. So if the owner of the policy cancels it and receives the cash surrender value, then the owner must recognize income equal to the difference in what they paid in premiums and the amount of money that they receive. So if you look at where is this? So if, for example, we have Victoria cashed in her life insurance policy and she received the cash surrender value of $25,000, which is the cash surrender value. She has paid $13,000 in premiums. So how much income will Victoria have to recognize with this? Essentially, it's a sale, okay? Right, $12,000, the difference between what she paid and her amount realized. This is her amount realized, this is her basis. Okay? Alright. Now, similarly, well, if you sell your policy to a third party, you also have to recognize income in the exact same way as a cancellation. Okay? If a cancellation is considered a sale or exchange, obviously selling a policy is considered a sale or exchange. Okay? There is an exception to this. Okay? So this is an exception to the exception. Exception for chronically or terminally ill patients. So, if a patient is chronically or terminally ill, they can sell their policy and not have to recognize any income. If they are chronically or terminally ill. Chronically ill is defined as someone who needs assistance for everyday life, such as going to the bathroom, taking a shower, etc. Terminally ill means they have been diagnosed by a doctor as having 24 months or less to live. Okay? Now, there is a difference in the limitations for chronically versus terminally ill. If the taxpayer is chronically ill, they can only use the proceeds to pay for their care. Okay? if they are terminally ill, they can use the proceeds for whatever they want to. If they want to go to France, if they want to go to the Final Four games, whatever, doesn't matter. They still do not have to recognize any income from selling that policy. And we'll do an example here. Okay. There is another exception, okay, to this. There's too many up here, but if you look on page 5, 6, there are 5 exceptions on here, which basically says if you transfer or sell the policy under one of these circumstances, we are not going to make you recognize gain. Okay? So I'll just put certain circumstances, page 5, 6. These are things like if you transfer a policy to the beneficiary. And there's an example in the book on page 5-7, example 7. When Logan's daughter Emily was born, he purchased an insurance policy on her life. 24 years later, Logan sold her the policy for its fair market value. Okay? When Emily dies, the transfer for consideration rules will not apply. So that means that Logan is not going to have to recognize any kind of income here. We're going to pretend like we're under the general rule because he is just transferring it to a beneficiary on the policy. And the rule, it would be the same whether he sold it or gifted it. It does not matter. Okay, that's one of these examples of special circumstances. Some others is if the policy is received by a gift, if it's pursuant to a buy-sell agreement, which we're not talking about in this class, if it's pursuant to some other tax-free exchange, etc. Okay, so let's do a couple examples here. This is example 4 in the book. Tom owned a life insurance policy at the time he was diagnosed as having a terminal illness. He paid $5,200 in premiums for this policy. And he sold the policy to Amber Benefits, Inc., a company that is authorized by the state of Virginia to purchase such policies. Amber paid him $50,000. Okay. When Tom died 6 months later, Amber collected the face amount of the policy, or $75,000. Okay? So Tom dies, $75,000 is paid. Okay? So, is Tom going to have to recognize any income upon transferring this policy? No, because he is terminally ill, and that is an exception. Okay? Now, when Tom dies, $75,000 is paid. Is Amber going to have to recognize any income? Yes. Yes. Equal to the difference in what they paid for it and what is received when Tom dies. Now, let's say Amber had paid an additional $4,000 in premiums before Tom died. So that means Amber's basis in this policy is now $54,000. So when Tom dies and $75,000 is paid, Amber will have to recognize how much? $21,000 of income. the difference in their basis of $50,000 paid plus $4,000 additional in premiums minus what they receive when Tom dies. So let's also talk about example 6, similar. Okay, in this example, Adam pays premiums of $4,000 for an insurance policy. These are races. So Adam pays $4,000 for a $10,000 policy on Beth. So we're covering Beth's life. Then he transfers the policy to Carol for $6,000. And then Beth dies and Carol receives $10,000. Okay? So, when Adam sells the policy to Carol for $6,000, does Adam recognize any income? Yes, $2,000. When Beth dies and Carol receives $10,000, does she recognize income? Yes, $10,000 minus what she paid, which is $6,000. So we have $4,000 of income recognition. Okay, you do have some problems similar to this on your exam. So. Okay. That's pretty much it on insurance proceeds. Next topic, scholarships. Okay. Luckily for y'all, scholarships are not included in income. So they are excluded from income. That is the general rule. Scholarships excluded. There is an exception if the scholarship is used to pay room and board. If the scholarship is used to pay room and board, it is included in income. Okay? So, to the extent it's used for tuition, fees, books, supplies, equipment, no problem, all that's fine, it's excluded from income. But if it is for room and board, it is taxable. Okay? And of course, to the extent that it is really compensation, for example, when I was in school, I was a graduate assistant, and as part of my graduate assistantship, I got a scholarship for half of my tuition and a $1,500 a month living stipend. Okay? So that living stipend is not part of the scholarship, that's just compensation, and that's included in regular income. So, if you receive a waiver for your tuition, that is not included in income. So often with state schools, sometimes they will waive out-of-state tuition if it's for a college athlete, or if somebody is already receiving a scholarship, they will waive out-of-state. If they waive the tuition for any reason, that's not considered a scholarship, it's just a waiver, but it is not included in income. Okay? So really the only thing we have that is excluded from this is room and board or just regular compensation, which isn't really a scholarship. So, if we look at example 8 in the book on page 5-7, Terry enters a contest sponsored by a local newspaper. Each contestant is required to submit an essay on local environmental issues. The prize is 1 year tuition at a state university. he wins the contest. Is that a gift? No, it is not a gift, okay? Because they are required to pay, so there's an obligation, it's not a gift, but is it a scholarship? Yes, it is a scholarship because it's for his tuition, okay? To be considered a scholarship, okay, the recipient must be a candidate for a degree. We look at example 9. We have Kevin, who received an athletic scholarship from the school. The scholarship pays tuition of $9,000. So we have $9,000 of tuition, $2,400 for books and supplies, and $4,500 for housing and food. Housing, food, laundry, transportation costs, stuff like that. Okay? And you will have some problems like this on your exam. Okay? And the problem may say, what is excluded from gross income here? Or what is considered as a non-taxable scholarship? The $9,000 for tuition and the $2,400 for books and supplies. But what if the problem says, what is included in gross income? Well, now the answer is $4,500. So depending upon what the problem is asking, of course, it will affect your answer. So on the exam, make sure you read what the problem is asking. If they're asking what is included in gross income, it's this. If they are asking what is not included in gross income, or what is a non-taxable scholarship, it is this and this. Okay? And since one whole chapter on the exam covers exclusions from gross income, you will have a lot of questions like that. Not just questions related to scholarships, but questions that will say, what is excluded from gross income? Or what is included from gross income? Make sure you read the question. Does it say excluded or does it say included? Because they are opposites. Okay? Right. Okay, so our big picture facts. Paul was paid $400 a month to teach a principal's course. Okay? He received this because of his excellent academic record. That is not a scholarship. That is compensation for services. Okay? And it's not even included under this exception. Now, he also received a $6,000 tuition reduction. That is excluded from gross income. The tuition reduction is excluded. It's not really a scholarship, but it is excluded. Okay. The next concept is damages. One second. So, damages are what you receive from a lawsuit, okay, or from the insurance company pursuant to a lawsuit. They can be for a loss of income, for property that's destroyed, for injury, etc. Okay? And they kind of convolute this a little bit in the book. Okay? So, the general rule is that damages are included in gross income. Okay? There is an exception where we exclude damages It is for personal injury or sickness. Now, this includes loss of income related to personal injury. It includes medical expenses, attorney fees, all of that. If it's related to a personal injury, it is excluded. But there is an exception to this. Punitive damages. Punitive damages are damages made to punish the person who caused the injury. If punitive damages are received, even if they are received pursuant to a personal injury claim, they are included in income. Okay? So if you have damages for loss of property, so your house gets destroyed by some teenager who runs his car into it. Okay? That is included in gross income, equal to the difference in what you paid and what you received. Okay? However, if the car running into your house hits you and causes you damage, and you break a leg, and you have to go to the hospital, and you get paid for your medical expenses, and you get paid because you have to miss 2 weeks from work, that is excluded from income. Okay? So the key thing to look for is there personal injury, as an injury to a person, not to a piece of property, but to a person. Okay? If a person is injured, then those damages are excluded unless it is punitive damages. Okay? So they make it a little bit too complicated in this book. But let's do an example. Okay? Actually, this is the big picture facts. Right here. Okay? So Paul, you remember Paul was in an accident. Okay? And he received some damages, which are on page 5.1. He received $30,000 for medical expenses because he was hit by this van. Is that excluded from income or included? Excluded, right? Related to his injury. He received $100,000 for injury to his right arm. These are compensatory damages. Is that excluded? Right. $50,000 for pain and suffering. Excluded because it's related to his injury. $15,000 for loss of income. Excluded. Legal fees, $25,000. Excluded. Punitive damages of $160,000. Included, right? In addition, his mother received $25,000 because she witnessed the accident. Included in her income or excluded? Included. Because she was not injured. Her son was injured. Okay? It matters who is injured. Okay? Okay. That's pretty much it for damages. Because they make it a little, I don't know why they convoluted it so much. Okay? Let me go back a couple slides. Okay. Along the same lines, we have workers' compensation. Workers' compensation is you get injured, okay, and you apply to your employer for workers' compensation, and they give you money because you're injured. Workers' compensation is not the same as damages, okay? There's not a lawsuit involved, okay? Workers' compensation is excluded from gross income. Okay? Note that this is different from unemployment compensation, which is included in income. Workers' comp is excluded. Okay? Workers' comp is related to injury. topic we are going to talk about is accident and health insurance benefits. Okay, so there is a difference between if the individual taxpayer is paying for it versus if the employer is paying for the policy. So if you have an individual taxpayer paying for the policy, okay, the benefits received are excluded. So if you have a taxpayer, they buy a disability policy on the open market and they become disabled. This policy pays them money for their loss of income. That is excluded from gross income. If the same policy had been purchased by the employer, that money would be included in gross income. Okay? So it depends with who's paying it. Okay? We're going to talk about the employer right now. Okay? So with policies, there are really two components here. There's the premiums and the proceeds. You guys are probably all familiar what premiums are. I mean, you have health insurance policies. You pay your premiums every month for your health insurance policy. Okay? If an employer pays for the premiums on these policies, right now we're talking about employer-sponsored plans. Okay? Which is what we're going to talk about here for the next 10 minutes. Employer-sponsored plans. And with employer-sponsored plans, if the employer pays for the premiums, okay, that is not included in income of the employee. There's been some talk out there of the law changing on this, but as the law stands, those premiums are not included in the income of the employee. Okay? Now the proceeds are what is paid from the policy. Okay? So this means you have a health insurance policy, you break your arm, you go to the doctor, you get a bill for $5,000 for the x-rays. It gets sent to your insurance and your insurance pays $4,000. That $4,000 is the proceeds, okay? Because it is paid out of the policy. Okay? Proceeds are not included in income. Okay? If received for medical care or permanent loss of a body part or function. So this permanent loss of a body part or function is really related to some type of accident or disability policy. And the medical care is really for medical insurance. They don't say that in the book. That's what makes sense to me. Okay? So, again, please note, this is for employer-sponsored plans. We will talk a little bit later how it works for health insurance if you are self-employed and you have your own health insurance policy. We will talk about that later in Chapter 9. So we're just going to sit on that for now. Okay? But, let's see. what is considered medical care is defined in the code, okay? It has to be for something related to medical purposes. There's an example here in the book where the tabbed employer-sponsored healthcare plan pays $4,000 for hair transplants that do not meet the code's definition of medical care. This is example 15. Well, since the hair transplants are not medical, these proceeds will be included in the taxpayer's income. But the general rule is, if it's for medical purposes, the proceeds are not included in your income. Okay? So if it's something that's purely for cosmetic purposes, like like a boob job, or you're getting some kind of weight reduction surgery, those would be the kind of things that the code says doesn't qualify for medical care and would be taxable. Okay? What about permanent loss of a body part or function? There is an example in the book. This is example 16. Jill loses an eye in a car accident unrelated to work. She incurs $2,000 of medical expenses, and she collects $10,000 from an accident insurance policy carried by her employer. Okay? Because the payment is for a loss of a member or function of the body, the $10,000 is excluded from gross income. Okay? However, she also receives $500 from the policy for basically loss of income because she can't go to work. That $500 is included in gross income. So please note that this limitation really only applies, it doesn't apply to like loss of income. Okay? Now what if this had been a policy purchased by an individual? Then even the proceeds for loss of income or loss of work would be excluded from gross income. So we have a different consequence because the employer pays for this policy than if the individual had paid for the policy. Okay. Okay. The book talks about this concept of a health savings account. Now, I definitely do want to spend some time on health savings account, but I don't want to do it in this chapter. We're going to do it later in chapter 9, which is where you will be tested on it. You are not tested on it in this chapter. But I will mention it briefly, okay? So a health savings account is something a lot of you will take advantage of when you start working, which is why I like to spend a good bit of time on it, because so many of you will see it when you start working. So a health savings account is a high deductible medical insurance plan, okay? And with this plan, you make contributions to a savings account. And when you have a medical problem, you can take amounts out of this account tax-free. Okay? And you can contribute into the account for certain amounts. Okay? And you can take it as a deduction on your return. Okay? So you actually get two benefits. You get to take a deduction for the contributions, and the deduction can be huge. Okay, it can be, what is it now? I think that's it, $67.50 a year for family coverage. So you can take a deduction for that contribution every year. In fact, I know some people use it as a tax planning technique. They can wait till the end of the year, and if they have more income than they like, they contribute a bundle of money into their HSA account, which one gives them a huge deduction, and your HSA account carries over with you every year. I have a friend who's been working at a Big Four accounting firm. He has close to $30,000 in his HSA account. Why? Because he makes contributions every year, and it just keeps on, pulling over every year. It doesn't ever cap out. So if something big medical ever happens to them, he has $30,000 in that account that he can use tax-free. And he's already gotten a tax benefit for the deduction. So it can be a huge tax benefit, and a lot of you will take advantage of it when you start working. And we will talk about that a little bit later in another chapter. Okay. Along the same lines, we have long-term care benefits. So if an employer pays for a policy to cover long-term care, the premiums are excluded, or not the premiums, the proceeds are excluded to the extent they are used for long-term care. They also have a daily statutory amount, which is currently $340 a day. This provision is a little bit taxpayer friendly because the taxpayer can, they get to use the greater of the amount paid or the daily statutory amount. So let's look at an example. This is example 17 on page 513. We have Hazel, who suffers from Alzheimer's disease, and she's a patient in a nursing home for the last 30 days of 16. While in the nursing home, she incurs $7,600 of costs, and she receives $3,500 from Medicare. And the insurance pays her $7,000 for her long-term care insurance. This is what she gets from her long-term care policy. So we want to know, how much does Hazel have to include in income? Okay? So she has to, she gets to consider either, like I said, the greater of the amount paid, which is $7,600, or the daily statutory rate of $340 a day times 30 days, which is $10,200. Okay? So, if she gets to use the greater of these, we're looking at $10,200 as the amount of her costs. Of course, that's not the actual amount of her costs, but this is the amount that Congress says she gets to consider to be her costs. Okay? So if she has $10,200 of costs, and Medicare paid $3,500, we have $6,700 of costs post-Medicare. And she received $7,000 from her policy. How much is she going to have to include in income? $300, right? The difference between what was paid out on the policy and what she used to pay for her long-term care. Okay? Note that we get to use this higher amount based upon the daily statutory rate. Okay? We don't have to use her actual costs, which means she has to include $300 in income. The remainder of $6,700 is excluded from income. Okay? Okay. Now we can talk about the next topic. Which is on meals and lodging. for meals and lodging to be excluded, they must be, let me go to the next slide. Furnished by the employer on the employer's premises furnished for the convenience of employer and the last one, which really only applies to lodging, required as a condition for employment. So, for example, if you have a hotel manager and he is required to stay on the premises while he is working, and he is provided a hotel room to use during that time period that is furnished by the employer on their premises for the condition of the employer and is required as a condition for employment. So he does not have to include the value of that hotel room in his income. The same thing would be said for a manager of an apartment complex. If they are provided an apartment free of rent, then that would be the same type thing. Meals, if they're furnished by the employer on the premises and for the convenience of the employer, they are not included in the employee's gross income. So, and the regulations give some examples of excluded meals. This is on page 514. A restaurant requires its service staff to eat their meals on the premises during a busy lunch and breakfast hours. A bank furnishes meals on the premises for its tellers to limit the time the employers are away from their booths. A worker is employed at a construction site in a remote part of Alaska. The employer must furnish meals and lodging due to the inaccessibility of other facilities. Okay? So, it's pretty much self-explanatory. There are a couple things, I don't know if they're included in the slides, but there are a couple other housing exclusions. For example, ministers can exclude the value of a rental home provided, like a rectory or a vicarage, okay? Or if a rental allowance is given to them, that's also excluded from their income, so we have a special exception for ministers. There's also a narrow exception for campus housing, okay? I imagine that might be some kind of like an RA or something like that in a dorm. That's pretty much it for housing and meals. So when we come back on Monday, we are going to finish this chapter going with, actually I'm taking it back, there's one other thing I want to talk about that I talked about in the last class and I want to talk about now so that we're all on the same page. And we still have 15 minutes. So, okay, and this is on your exam, so I want to make sure everybody understands it. This is later in the chapter, but it makes sense to talk about it now. There's something called the tax benefit rule. Okay, now what this rule says, okay, is that if a taxpayer receives a benefit in year one, this being a deduction is what we're talking about, then receives reimbursement or a refund of some sort in year 2, that is otherwise excludable from income, the taxpayer must include in income the amount of the benefit from year 1. So we see this a lot with health insurance, which is why it makes sense to talk about it now. We really see it in 2 circumstances, with health expenses and with state tax refunds. Okay? In this chapter, it's discussed, well, it's really discussed for both purposes, but we've been talking about health insurance right now, so we're going to talk about it in the health insurance context right now. So let's say you have a taxpayer, okay, and in 2016, they pay out of pocket $2,000 for health expenses. And in 2016, they take an itemized deduction of $7,000, and they are a single taxpayer. That's their status. Then in 2017, they receive a reimbursement from their health insurance of $2,000. Now, we haven't really talked about this yet, but remember, a taxpayer either takes an itemized deduction or a standard deduction, okay? They take the higher of the 2. A medical expense deduction is only an itemized deduction, okay? You cannot take a medical expense deduction, okay, as part of the standard deduction or some other deduction out there, okay? The deduction is only an itemized deduction. So this taxpayer took a $2,000 deduction. We'll say they took a $2,000 itemized deduction. It has to be an itemized deduction, okay? And this deduction is included as part of this $7,000. And then in the next year, the taxpayer got a reimbursement of $2,000. So to the extent they received a benefit, i.e. they received a deduction in a prior year, they have to include this amount in income. Is this amount normally included in income? No, because it's payment for medical expenses. Okay? So normally, they would not include this in income. But because they took a deduction in a prior year, i.e. they got a benefit, they do have to include it in income. The question is, how much benefit did they receive? Was it $2,000? No, it's not $2,000. Because remember, a taxpayer can either take a standard or an itemized deduction. The standard deduction in 2016 for a single taxpayer is $6,300. So if this taxpayer has a standard deduction of $6,300, how much benefit are they really receiving from this $2,000? Really only $700. I want to make sure everybody sees this because you do have a problem similar to this on your exam. This taxpayer could take a $6,300 standard deduction. This includes no deduction for medical expenses. Okay? But the taxpayer got to take a higher deduction of $7,000. So their benefit from this is really only $700 or the difference between the standard and the itemized deduction. Now, what if the taxpayer had instead taken an itemized deduction of $8,500? Now, how much of a benefit did the taxpayer receive? What do y'all think? Because you're subtracting the standard from the itemized, right? But they only received a $2,000 reimbursement. So the cap is $2,000. So really, the benefit they had received in this circumstance is $2,000, right? Because this is the amount of reimbursement that they received, which is normally excluded from income. Because they took a deduction for it in a prior year, they will have to include the entire $2,000 in income. Now, what if the taxpayer had instead decided to take the standard deduction? Now, when they receive their reimbursement in 2017, how much they include in income? None, right? None. Do y'all see that? I'm not getting any answers. Because they did not get a benefit from it. Okay? There is no medical expense deduction in a standard deduction. You have to itemize to take this deduction. If the taxpayer chooses the standard deduction, they did not get any benefit from this $2,000 of health insurance. So they didn't get to take a deduction for it. So when they receive their reimbursement in 2017, they have $0 that they include in income. Because it's a reimbursement for medical expenses. The example in the book, which I definitely encourage you to look at, is at the end of the chapter, on page 526, example 34. This example is on a state income tax refund, okay, which works exactly the same. You see this a lot with state income tax refunds. Why? Because you get to take an itemized deduction for state income taxes paid. And if the next year you receive a refund from that state, you have to go back and include in income anything that you took a prior deduction for. And it works exactly the same, where you are comparing the standard versus the itemized. And if the taxpayer only took a standard deduction, they don't get to take an itemized deduction for those income taxes paid. I know it seems like, oh, we're jumping forward to itemized deductions. We haven't talked about that yet. It's kind of hard in this class not to do some jumping around because some things affect others, okay? And I would encourage you, take a look at Schedule A, okay? Which is the schedule for itemized deductions. Even though we haven't talked about it yet. It's pretty simple. Take a look at it. These are all the things that are itemized deductions. If they are not on this list, they are not itemized. Okay? There's not all that many things on the list. Take a look at it. Okay? It might help your understanding of this concept. Okay. So, that's pretty much it. Next time we'll pick up with this chapter.